Welcome to This Explainer. I am absolutely thrilled to have you here today because we're going to completely demystify one of the most talked about yet, widely misunderstood financial markets in the entire world, Forex. We're going to strip away all the hype, clear up those common misconceptions, and really build a rock-solid understanding of exactly what happens when currencies are traded.
Okay, let's dive right into this. Have you used the Forex market today, or maybe sometime this week? Now, you might be thinking, wait a minute, I don't even have a trading account. Well, the truth is you have probably used the Forex market before, even if you have never opened a trading account. Whether you were just converting cash for an overseas holiday, buying a product online that was priced in another currency, or maybe you run a business paying an international supplier, you have participated in foreign exchange.
And that brings us to our core definition. Forex is literally just short for foreign exchange. At its absolute basic foundation, it begins with simply exchanging one currency for another. But when we talk about it as a financial market transaction, it comes with a specific expectation that the relationship between those two currencies is going to change. That word relationship is absolutely crucial. It's the bedrock of everything we're going to cover today.
Let's look at exactly why this exchange is necessary in the real world. Imagine a company in Kenya needs to import some new equipment from a supplier over in the United States. Obviously, the American supplier expects to be paid in US dollars, right? Not Kenyan shillings. So step 1, the Kenyan company initiates the import. Step 2, the US supplier requires payment in USD. And step 3, those Kenyan shillings must be converted into US dollars to make that happen. Now, I want you to multiply this everyday scenario by thousands of companies, banks, governments, and travelers doing this worldwide every single day. That's what creates this massive, constant demand for different currencies.
Section 1. The mechanics of pairs. Comparing currencies on a balanced scale.
Now, what's really interesting about this is the balanced scale metaphor for the euro and the US dollar. In Forex, every single transaction involves two sides. You can't just buy a euro in isolation, you have to buy it with something else. So when you trade a pair like EUR/USD, you're simultaneously buying the euro and selling the US dollar. You aren't asking the market, hey, is the euro strong globally? Instead, you're asking a relative question. Is the euro likely to strengthen or weaken compared with the US dollar? Because, a currency could easily be rising against the dollar while dropping against the British pound at the exact same time.
To read these pairs correctly, we just break them into two distinct parts. The first currency in the pair, like the euro in our example, is called the base currency. That is the one you are actually buying or selling. The second currency, the USD, well, that's the quote currency. It's literally just used to express the value of the base currency. So if the exchange rate for Euro USD is 1.10, that simply tells you it takes 1.10 of the quote currency, US dollars, to buy one single unit of the base currency, the euro.
So the crucial point is, buying the pair means expecting the first currency to strengthen against the second. If you buy Euro USD at 1.1000 and it moves up to 1.1100, boom, your idea was correct. The euro gained value relative to the dollar. But what if you expect a currency to lose value? Well, selling the pair, say GBP USD at 1.2700, means expecting the first currency to weaken against the second. If it falls down to 1.2500, your idea was spot on. Being able to potentially benefit from both rising and falling markets just by taking different positions is a massive feature of Forex trading.
Section 2. The market ecosystem. Who moves the market and why?
You see, the Forex market doesn't happen in one big central building somewhere. It's this massive over-the-counter, or OTC network, operating electronically 24 hours a day during the week. And just look at the major players involved. We've got central banks managing national monetary policy, commercial banks executing massive transactions, international companies doing business, huge investment funds, and even whole governments. Oh, and finally, we have retail traders, folks sitting at home with a laptop. It's so important to ground ourselves here. As retail traders, we are literally just a tiny piece of a massive, globally interconnected institutional puzzle.
And this brilliantly illustrates exactly why prices are constantly moving. It's a super logical four-step chain reaction. Step 1, economic news hits. Maybe it's a report on inflation or jobs. Step 2, that news causes those massive institutions we just mentioned to completely shift their expectations about the future. Step 3, because their expectations changed, their immediate demand for certain currencies changes. For instance, they might start buying up US dollar assets. And step 4, because demand changes, the exchange rates move. It is a continuous, real-time, cause and effect loop.
But guys, there is a massive catch here, and it's the concept of being priced in. This is where so many beginners get totally thrown off. They see positive economic news, they buy a currency, and then they watch in absolute shock as the price drops. No way, right? Why does that happen? Because Forex is fundamentally a market of expectations. Markets react to what is expected next, not just what's happening right this second. If traders already expected that positive news, they likely bought the currency days or weeks ago. By the time the news actually breaks, the event is already priced in, and those same traders might actually be selling just to take their profits. Trading isn't about predicting the future. It's about making disciplined decisions under total uncertainty.
Section 3. The Retail Reality. Speculation versus Physical Exchange.
Let's move to and see how this builds into what you'll actually experience on a trading platform. We really need to clear up a common online misconception. When you, as a retail trader, click buy on Euro/USD, a suitcase full of euros isn't going to be delivered to your front door. Instead, you are trading price movement electronically. Sure, the underlying idea is kind of like a physical currency exchange desk at an airport, but the electronic reality is totally different. You're a speculator. Your platform records your position electronically, and a retail trader's profit or loss is simply calculated from the mathematical difference between the entry and exit prices.
I want to leave you with this final, really provocative thought. Forex is not just a chart. Every price represents the changing relationship between two currencies and the economies behind them. When you look at your screen, try not to just see random colorful lines zigzagging everywhere. Those lines are the visible, real-time result of real global forces. Economies, businesses, governments, fear, confidence, all interacting at once. Your job isn't to perfectly predict every move. It's to understand what you're looking at, manage your risk, and interact logically. I really hope this explainer helped build that foundation for you today. Keep learning and stay focused.